This is the Nedgroup Investments podcast, a space where you can learn more about our fund managers, the funds they manage, as well as getting up-to-date and important developments affecting the investment world and how they might be relevant to you.
Welcome to this special installment of the Nedgroup Investments Multi-Management Podcast. I'm Leandra Temmers. Today we will be reviewing the main investment drivers for the 2019 year, and given that we have seen new and different vulnerabilities coming to the fore, each one equally important and any one of which could lead to market ruptures, we highlight some of the most important themes that are likely to play out in the year ahead. To unpack this further, I have with me Trevor Garvin, Head of Multi-Management at Nedgroup Investments. Welcome, Trevor.
Thank you, Leandra.
I think to start off with, despite 2019 bringing its challenges, the spotlight has recently shone brightly on SA following the Rugby World Cup win. But in the same vein, South Africans now finds themselves being plunged into darkness just ahead of the festive season, further dampening the hopes for an economic recovery. How has this low domestic growth environment this year influenced investor decision-making?
Yes, so I think, Leandra, if we just look at the economic growth, first of all, in South Africa in 2019, so it definitely has disappointed on the downside. So we saw economic growth probably for 2019 sitting at 0.5%, which was really downgraded from the 1 to 1.5% that was expected at the start of the year. For 2020, we actually see that trend continuing with economic growth probably sitting at around 1 to 1.5%, down from the 2% that was originally forecast. So there's lots of pressure on the South African economy, and we see that coming through in many different ways as well. We know, of course, with the load shedding that we're currently having, it's also putting further downward pressure on economic growth. In addition to that, the South African tax revenue services are under pressure with lower tax revenue. We also know that government debt is increasing, which is not great and puts a higher interest rate burden on the government in terms of their interest payments that they have to pay out of their tax revenue. And all in all, I think the government also is under pressure with state-owned enterprises. We know that they've had to pump 60 billion rand or so into Eskom. We know that they've had to pump some money into SAA recently, which has now just last week been put into business rescue. So in addition to this, outside globally, we also have quite a few issues going on. In fact, just today is the elections in the UK, which of course is going to have an effect on the Brexit outcome. We probably anticipate that the Conservatives are going to win the election, probably with a small majority, and be able to push through the Brexit deal early in 2020, but then spend the next year negotiating their trade deals with the EU. We also have, of course, the US and China trade tensions, which is ongoing. We have problems in the Middle East. So all in all, I mean, there's quite a lot of, I think, uncertainty out there. So if we actually go and look at where have people been putting their money in the market, currently really in 2019 in South Africa, about 75% of the flows have gone into cash, enhanced cash or bond type investments. We can understand that. I think both bonds and cash has been giving you somewhere between 8 to 9% return, with inflation currently at about 4%. This gives you a real return of 5% or so for cash and bond type investments, which is probably one of the highest real returns that one can find globally in terms of cash and fixed income. So that's really where the flows have been going, which I think also is an indicator of people's cautiousness. Of course, what we worry about is whether people are taking enough investment risk, because we know that over the long term, equities, whether it be domestic equities or global equities, is what drives ultimately capital growth and long-term investor returns. So we also are cognizant of the fact that perhaps people are not taking enough risk at this point in time. But it's really, given all of these global jitters as well as the issues in the South African economy that are causing people to go down the risk spectrum largely into cash and enhanced cash products.
So given that the weak local economy has essentially kept a lid on inflationary pressures, and it's a bit of a hotly debated argument whether the SARB could have been a bit more aggressive in cutting interest rates. We've seen major global central banks such as the US Fed cut interest rates, which did create a window of opportunity for the SARB.
Yes. So, interest rates in South Africa is, again, one of the big hot debates. So we have seen interest rates basically been put on hold recently. And I think largely in South Africa, there are probably two main schools of thought. The one school of thought, which has largely been where the central bank has been coming from, and the governor, which has been saying that they need to keep inflation in South Africa under control. We know that their target for inflation is somewhere between 3 to 6%. Historically, they've generally targeted the midpoint, which is 4.5%. And at last measured, inflation was actually sitting at more like 3.7, 3.8%, so even below the midpoint. However, they kept interest rates unchanged and largely on a forward-looking view where they were saying that South Africa is in a bit of a dire financial straits. Our economy is under pressure, and hence looking forward into 2020, there might be one, inflationary pressures, and two, rand weakness coming into the economy, and also possibly oil price hikes. So all of that would have actually increased inflationary pressures in the South African economy, which as inflation pushes up, so that would put upward pressure on interest rates. The counter argument I think that we've seen in the country is more the economic one, which is where we know we have massive unemployment. We know that the economy, as I mentioned earlier, is growing only at 0.5% per annum, and we need it sitting somewhere at like 2.5 to 3%. So how do you traditionally get economies growing? And that is through lowering interest rates, because by lowering interest rates, the consumer has more cash in his pocket and hence drives economic growth. So depending on, I guess, which side of the fence you fall, one will have a differing view on the central bank and what interest rate policy they should be following. We, as Nedgroup Multi-Manager, I think certainly see interest rates probably staying flattish for the next 12 months going into 2020. I think that the central bank is going to be keeping a close eye on inflation in South Africa. But I do think, and particularly now with the load shedding, that they're going to have increased pressure, particularly from things like the trade unions, etc., to possibly ease the burden on the consumer, and interest rates perhaps could be cut going into the future.
Another important theme that's been played out in both the local and on an international stage is policy uncertainty. The lack of policy implementation has slowly eroded both business and consumer confidence. The state of SOEs has also been a clear pressure point, and not all credit rating agencies were as forgiving.
So if we look at really, I think the rating agencies, of course, the main news in the last couple of weeks has been Moody's, that has put South Africa on negative outlook. So they're the outstanding ratings agency, the only one that has kept South Africa really at investment grade. So by putting us on negative outlook, with the next step being that we would go in terms of Moody's ratings to junk status or non-investment grade, they've really said that it's the next 6 to 12 months is critical in terms of the South African economy and what policies the government implements. So it's really going to have to be seen really over the next 6 months of what policies the government takes and how they roll it out. And I know always the debate is really on how not only the policies that the government comes out with, but the actual implementation of these policies, and do they really roll them out and do what they say they're going to do. Having said all of that, Standard & Poor's, who already have South Africa on junk status, have have indicated that they probably were further going to downgrade the country, particularly now with the load shedding. And I actually think that largely, if we look at bond yields, we see that the South African market has priced in our downgrade already in terms of with Moody's. So should Moody's actually downgrade us going into the future, the next 6 to 12 months, I don't think it will come as a shock to the system. I think the market's priced it in largely already. And yes, people are expecting large capital outflows. They talk about sort of somewhere between 60 to 100 billion rand flowing out the country from global managers who hold South African bonds in the indices. But likewise, there are many global fund managers who still buy non-investment grade bonds. The South African bonds, as I mentioned, show or offering amazing yields of around 9-10%. And between that, the market pricing it in, I don't actually anticipate any major problems coming in on that side.
Well, wrapping up and looking ahead, Trevor, 2019 has very much brought with it some of the baggage from 2018. Can you share with us your top 5 investment themes and what surprises, if any, are we likely to see leading into 2020?
Yeah, so I think if we start off globally, our view really is that we think that the global economy will probably slow down going into 2020. Economic growth, global economic growth, I think will probably slow. This year, we're looking at 2.5% to 3% real GDP growth. I think 2020, we may be going to see closer to 2 to 2.5%. But we certainly don't see the world going into a big recession. We still think that the US will stay relatively strong. We do see it slowing down. We also see Europe slowing down, but we don't see a big recession on the horizon. In terms of the US, I mean, if we look at the US, the job market is still extremely strong, but we do see a bit of slowing down in terms of their manufacturing part of the industry, which is partly also linked to the US-China trade negotiations, as well as all the tariff battles between the US and EU. So just yesterday, in fact, the US Fed was announcing that they foresee that in the US, interest rates will probably be unchanged in 2020. And in terms of raising interest rates in the US, he was only forecasting raised interest rates if he sees persistent, strong inflation in the economy. Now, certainly at the moment, that's not the case. And if anything, the markets are actually pricing in some interest rate cuts going into 2020 coming from the US, which would help stimulate both the US economy and generally the growth within the EU. On the South African front, as I've said, there are many headwinds here. State-owned enterprises are an issue, the power outages. We have high unemployment in South Africa. There's pressure on the rand. At the moment, the rand's actually been relatively strong, but we think that there might be downward pressure on the rand. Having said that, in terms of South African equity valuations, actually there are pockets of value showing through in the South African equity market. So really, I think in terms of our sort of views on the market for 2020, I think it's all about diversification. One has to be diversified both locally and offshore. 2020 is going to be a year of increased uncertainty. I think it could be a year of increased volatility. But we do actually foresee still positive returns coming through both locally and globally on the equity side, as well as within South Africa on the fixed income side where yields are particularly strong.
Thank you, Trevor, for your time and for sharing some of your insights with us. That was Trevor Garvin, Head of Nedgroup Investments, Multi-Management in Cape Town.
Nedgroup Collective Investments is an authorised collective investment scheme manager in terms of the Collective Investment Schemes Control Act. Nedgroup Investments does not provide advice on financial products and will only give you factual information. For further details on our funds and to view our terms and conditions, please visit nedgroupinvestments.co.za.